In the year 2000, Enron Corporation was the seventh largest company in America. It had $101 billion in reported revenue. It employed 29,000 people. Fortune magazine had named it the most innovative company in America for 6 consecutive years. Its stock traded at $90 a share. 16 months later, it was bankrupt. 20,000 employees lost their jobs. Their pension funds, which had been invested almost entirely in Enron stock on the company's recommendation, became worthless. Shareholders lost $74 billion. 3 of its executives went to federal prison. Its auditor, one of the 5 most prestigious accounting firms on earth, was convicted of obstruction of justice and ceased to exist. And the mechanism that caused all of it had been approved in writing by the United States Securities and Exchange Commission. This is not a story about greed. Greed is everywhere. This is the story of a specific accounting trick, one that turned projected future profits into reported current revenue, and how that single decision made everything that followed mathematically inevitable. Enron was founded in 1985 through the merger of 2 natural gas pipeline companies, Houston Natural Gas and Internorth. Its founder, Kenneth Lay, had a straightforward business: own pipelines, move gas, charge a fee. The unit economics were simple and stable. Gas went in one end, money came out the other. In 1990, Lay hired a consultant from McKinsey named Jeffrey Skilling. Skilling had a different idea for what Enron could be. Instead of just owning pipelines, Skilling wanted Enron to become a market, a trading platform for energy, a company that would buy and sell gas contracts, electricity contracts, broadband contracts, anything that could be packaged as a commodity and traded. Skilling's vision required one thing: a change in accounting rules. In a traditional business, you record revenue when you actually receive cash. Skilling wanted permission to use something called mark-to-market accounting, a method where you record the full projected profit of a long-term contract on the day you sign it, regardless of whether the money has arrived or ever will. In 1992, Skilling personally lobbied the SEC to approve mark-to-market accounting for Enron's trading operations. The SEC approved it. From that moment, Enron's reported revenue became a function of what its executives believed future contracts would eventually earn, not what the company had actually collected. The results looked extraordinary. By 1996, Enron's stock had tripled. By 1998, it had doubled again. Skilling became CEO in 2001. Andrew Fastow, a 36-year-old finance executive who had joined in 1990, was named CFO. Fortune called Enron the most innovative company in America. Wall Street analysts consistently rated it a strong buy. Its employees were told and believed that the stock would reach $130, $140, $150 per share. Inside the company, a culture had developed that rewarded one thing above everything else: the appearance of success. Traders who booked large projected profits were celebrated regardless of whether those projections were realistic. Executives who questioned the numbers were marginalized. A performance review system internally called Rank and Yank graded every employee against their peers and terminated the bottom 15% each year. The pressure to generate reported earnings, not real earnings, reported earnings, was total. The problem with mark-to-market accounting is what happens when the projections are wrong. If you sign a 20-year broadband contract and book $500 million in projected profits on day one, but the broadband business loses money every year, you have already reported a profit that does not exist. You cannot unreport it. You can only find somewhere to hide the loss. Andrew Fastow solved this problem by creating what are called special purpose entities, separate companies, technically independent from Enron, that existed for one purpose: to absorb Enron's losses off its balance sheet. Fastow created over 3,000 of these entities. He named 2 of the largest ones, LJM Cayman and LJM2, using the initials of his wife and 2 sons. He personally ran these entities. He personally profited from them. Enron's board approved this arrangement, meaning they approved their own CFO operating competing financial vehicles that were simultaneously doing business with Enron. Fastow earned $30 million from these entities while serving as Enron CFO. The entities worked like this. When Enron had an asset that was declining in value, a power plant that wasn't performing, a broadband investment that was failing, it would sell that asset to one of Fastow's entities at an inflated price. Enron recorded a profit. The loss stayed inside the entity, off Enron's books. The entities were capitalized with Enron stock, which meant that as long as Enron's stock price stayed high, the entities could absorb the losses. But if the stock price fell, the entire structure would collapse simultaneously. By 2001, Enron had used these entities to hide more than $1 billion in losses. Its auditor was Arthur Andersen, at the time one of the 5 largest accounting firms in the world. Arthur Andersen reviewed Enron's books and signed off on them. Andersen also earned $52 million per year in fees from Enron, $27 million for audit work, $25 million for consulting. The firm had a direct financial incentive not to find problems. In August 2001, a vice president at Enron named Sharon Watkins wrote a memo to Kenneth Lay. The memo said directly, "I am incredibly nervous that we will implode in a wave of accounting scandals." Lay showed the memo to Enron's lawyers. Enron's lawyers were hired from Vinson & Elkins, a firm that also earned millions in annual fees from Enron. The lawyers concluded there was no cause for concern. No action was taken on August 14, 2001. The same month Watkins sent her memo, Jeffrey Skilling resigned as CEO without explanation after only 6 months in the role. He sold $60 million of Enron stock before leaving. The resignation triggered scrutiny. Journalists at Fortune magazine had already begun asking a question that nobody on Wall Street had asked: how exactly does Enron make its money? The answer, when examined closely, was that nobody could explain it. The financial statements were too complex, the revenue sources were too vague, the off-balance sheet entities too numerous. On October 16, 2001, Enron announced a third-quarter loss of $618 million and disclosed for the first time that it was reducing shareholder equity by $1.2 billion to account for losses in Fastow's entities. The stock fell 20% in a single day. The SEC opened a formal investigation. Fastow was placed on leave. Enron's credit rating was cut to junk. Banks began withdrawing credit lines. On November 8, 2001, Enron restated 5 years of financial results, admitting it had overstated profits by $586 million since 1997. Enron attempted to survive through a merger with its rival Dynegy. Dynegy agreed in principle, then walked away after examining Enron's actual books. On December 2, 2001, 16 months after its stock reached $90 per share, Enron filed for Chapter 11 bankruptcy. At the time, it was the largest corporate bankruptcy in American history. The stock, which had traded at $90 in August 2000, closed on bankruptcy day at 26 cents. Arthur Andersen was indicted for obstruction of justice after employees were found to have shredded Enron documents following news of the SEC investigation. The firm surrendered its accounting license and effectively ceased operations. 85,000 employees lost their jobs at a company that had not itself stolen anything, but had looked away while its client did. Kenneth Lay was convicted on 6 counts of fraud and conspiracy in May 2006. He died of a heart attack in July 2006 before sentencing. Jeffrey Skilling was sentenced to 24 years in federal prison, later reduced to 14. He was released in 2019. Andrew Fastow was sentenced to 6 years. He cooperated with prosecutors and has since spoken publicly about what he did and why. Here is what actually killed Enron, and it is more transferable than most people realize. Enron did not collapse because of greed. Greed preceded the collapse by a decade, and the company kept growing. Enron collapsed because of what we can call the reported reality gap. Mark-to-market accounting allowed Enron to report a version of reality that was disconnected from actual cash flows. The reported reality, $101 billion in revenue, consistent profit growth, innovation awards, was real in the sense that people believed it and acted on it. But it had no cash underneath it. The gap between reported reality and actual reality can be sustained for years, as long as nobody is forced to reconcile the two. The reconciliation moment for Enron was the SEC investigation, the first time an external party with legal authority demanded to see the actual numbers. Within weeks of that investigation opening, the stock had lost 80% of its value. The gap closed violently because it had been growing for nearly a decade. The transferable lesson is this: any organization, a company, a startup, a fund, a government department, that rewards reported performance over actual performance will eventually produce a gap between the two. The longer the gap is sustained, the more violent the correction. Enron's employees were not criminals. Most of them had no idea what Fastow was doing. They worked hard, believed the numbers they were given, and invested their retirement savings in a company they trusted. The $74 billion that disappeared was not taken by 3 executives. It was a number that had never really existed, a projection of future profits that was recorded as present fact, compounded annually, until the fiction became too large to maintain. When someone asks how $74 billion disappears overnight, the answer is that it was never really there. The number was a story. And eventually, someone stopped believing the story. Every failure leaves evidence. We examine it. If this breakdown was useful, subscribe. A new case drops every week.